Is France on the verge of a full blown debt crisis and bond market meltdown? Today, we're diving headfirst into France's budget crisis. A financial mess has gotten so bad there's talks of an IMF bailout, with public debt soaring, deficits spiraling, and political chaos threatening to derail any fix. We're breaking it all down. Let's uncover why France is teetering on the brink and the massive implications for the global economy, including the US. So, here we're looking at the CAC index. This is France's version of the S&P 500, their main stock index. It is down over 3.5% just this week alone. So what's going on? There has been a fiscal crisis building, arguably for many decades, but is becoming acute. We'll look at the bond market towards the end, but the bond yields are signaling that this fiscal issue is becoming acute. So here we're looking at the unemployment rate in white, the fiscal deficit as a share of GDP. Remember, the fiscal deficit is the difference between what the government spends and what it collects in tax revenue. And then you're expressing it as a share of French GDP. And then comparing that to the unemployment rate. So generally, countries run a deficit during economic weakness when the unemployment rate is rising. And this is normally how it goes. However, once the unemployment rate comes back down, once the economy gets going again, the government will bring the deficit back to a normal, healthy level. That is not the case for France. We can see going back the past 25 years, their unemployment rate is actually lower, but their deficit went from 1.3% of GDP to an utterly insane 5.8%, basically 6% budget deficit. Now, the US runs about a 7% budget deficit, which is even crazier. But the difference is that a couple main differences. The US runs a much larger current account deficit, which we'll look at in a second. And it is also the reserve currency issuer of the world. So it can kind of get away with a little bit more than someone like France can. So the deficit as a share of GDP at 6%, by the way, the youth unemployment rate is very high, 17.5%. Even their headline unemployment rate is much higher than the US, about double what the US unemployment rate is at 7.5% on a U3 basis. That's about double what it is in the US. The youth unemployment rate is quite high, 17.5%. But the point here is that over the past 2 to 3 decades, the deficit has just grown and grown and grown, while the unemployment rate, reflecting kind of the broader economy, has not really moved. If anything, the unemployment rate has improved, but yet they are running larger and larger deficits. So that's what's known as a pro-cyclical deficit. Here we're looking at that current account. Now remember, this is mainly the balance of trade or the trade balance, the difference between imports, the value of imports, and the value of exports. And we can see that the deficit, the fiscal deficit, the difference between spending and revenue for the government, that has been growing all the way going back to the early 1960s. So arguably, this has been building for a long time, much like the US. But their current account is much better than the US. We can see the last print for the year 2024, they ran a very slight current account surplus of about half of 1% of GDP. But if you go back kind of post 2008, they've basically ran an average of a 1% current account deficit as a share of GDP. Now, the US is much worse, around 5% of GDP, depending on how you annualize the data. So here is one of the main key differences between the US and France. And one of the things that is important to watch is the oil price. So down here, we have the price of oil in dollars per barrel. And then we have the current account deficit inverted. So the same line we were looking at, just inverted. So as the green line is going up, the current account deficit, trade deficit, is getting worse. And the main point here is that Europe and France is structurally short energy. They are not like the US, where they have energy reserves domestically. They rely on imports for energy just to sustain everyday life. And so, as the price of that energy, as measured by oil in this case, as that gets more expensive, that pushes their current account deficit wider and wider because, again, energy is not optional. You need to fuel the tractors and the cars. It has to get to work, right? Energy is one of those things that you require no matter what. You lose energy and you lose civilization, basically, in today's day and age. So we can see that as the price of that energy gets more expensive, it pushes their current account deficit wider. Now, the other important thing to remember is the strength of the currency. So I'm going to take oil off. Now we're going to look at the euro dollar exchange rate and similar trend here. And the reason is that a strong currency prioritizes imports over exports. With a strong currency, with an overvalued currency like the dollar, in the case of the dollar, it becomes very cheap to buy stuff from the rest of the world, from say China, in the case of the US. But it means that your goods and services produced domestically, you can't sell to the rest of the world because in your currency is too strong, and therefore your goods and services are not competitive for the rest of the world. You can buy all their stuff, but on a purchasing power parity basis, on an exchange rate basis, your goods and services are way too expensive for them to buy. So what that means is you import more and you export less. Well, that's basically the balance of trade is basically the current account. There's other minor components, but basically that balance of trade is the current account. So as you import more and export less, your current account deficit gets worse. We can see the strong correlation where as the euro is strengthening, their current account deficit gets worse. So the euro strength that we have seen going back to say the beginning of the year or April, especially, the euro has strengthened notably. This is going to put pressure on the current account of France. Now we know their fiscal deficit is abysmal. So here we're looking at growth. And ultimately, this comes down to a story of growth, much like I've said for the US. Here we're looking at year over year real GDP growth. And again, much like the US, this has been declining. You can see that there is a downtrend in the rate of growth going back to the 60s, the kind of post World War II era. They at one time had 7, 8, 9% annual growth rates. Well, no longer. That kind of annual growth rate has been declining, arguably before the US, back in, say, the early to mid 70s. We can see that their current annual growth rate is a very slight 0.8% and has basically been below 1% for the past 3 years. And to make matters worse, their M2 growth rate, or M2 is the broad money supply, has gone negative. So their annual money supply growth is shrinking. This is deflationary. Remember, France, much like the U.S., debt-based monetary system, which requires an ever-expanding monetary supply. Here we're looking at inflation. Inflation is also quite anemic. Much like growth, their inflation rate is only 1%. Now, remember that low inflation can be a positive thing, depending on how your economy is growing. But generally speaking, if you have a low inflation rate, that signals poor growth. Well, here we can see that. We can see that their inflation rate is only 1% per year, and their real GDP growth rate is only 0.8%. So you add the two of those together, you get nominal growth, which is what matters for governments, of only 1.8%. Now, that you need to remember that number when we get towards the end and look at the bond market and what is going on there. 1.8% nominal growth. Well, here's why that matters. So in blue, I've shown this chart for the US, a version of it for the US. Here in blue is debt to GDP. And down here is the cost of the debt as measured by the interest rate on the 10-year government bond minus the nominal growth rate. And what you can see is that as that spread is positive, as the interest rate on your debt is higher than your nominal growth rate, I've highlighted a couple key periods of time, that means that puts pressure on the government and the debt. We can see debt to GDP goes up during periods of time where the interest rate on the debt is above that nominal growth rate. And similarly, during periods of time where the interest rate is below the nominal growth rate, the debt is not really an issue. Now, what we can see currently is going back to July of last year, for the past 12 months or so, the cost of their debt has risen above their nominal growth rate and is now 1.8% positive spread. This is when the debt becomes more of a burden for governments. I also threw on government spending as a share of GDP. This is another huge problem for France, much like much of Europe has this problem of an ever expanding bureaucracy, more and more government spending kind of notoriously inefficient, as we'll see in a second. Here is the individual kind of disaggregated components of GDP. We can see agriculture, construction, utilities, transport, manufacturing, much like the US, has been very flat. And this is a nominal figure. So it's even worse if you look at some of these things in a real inflation adjusted manner, it would be negative. So that is manufacturing, agriculture, construction, utility, and transport. We can see manufacturing so far playing a large role, 59 billion. Well, once you include government spending, it just blows everything out of the water. 167 billion, I believe this, yeah, euros, 167 billion euros per year. Here is another major component of the French economy, much like the US. We can see consumer spending is even double that of government spending at about 344 billion. And here's GDP that comes from those services. So much like the US, the French economy is oriented towards a service-based economy. Here we're looking at kind of two main sides of the economy. And going back to that current account story, here we're looking up top. Well, let's start below. So here we're looking at agriculture and manufacturing as a share of GDP. We can see agriculture back in 1950 was about 3% of French GDP and is now 1%. If you look at manufacturing, this actually started to boom during the 60s into the 70s, by the way, when France had very, very high growth. Manufacturing as a share of GDP was growing. It grew from about 10% of GDP up to about 12 or 13%. Well, going back to the mid 70s, early 80s, much like the US, manufacturing as a share of GDP has been declining. So something had to step in to take the place, much like the US. Here up top, we're seeing what stepped in. Government spending as a share of GDP and services, which we were looking at in part that consumer spending. Now, it's important to mention this was driving me crazy earlier, but the green line is not actually total government spending as a share of GDP, which is 57%. The green line, only measures final consumption expenditures only. So it's about half of what real government spending is on a total basis. Services as well measures a different share of the services economy, but France is mainly a services economy. But the government spending increasing, as we saw in the prior slide, 57% of French GDP is coming from the government spending money. This is even higher than it was in the UK, where we look there. So here, just to really drive this point home, this is critical to why France is in the mess that they are. Here we're looking at real GDP on a logarithmic basis. I've shown this chart for the US, and it's a similar story with the US, but much like the US, France had a strong rate of growth. This is real inflation adjusted economic output. If you take this growth rate, this works out to a missed growth of 2.3 trillion euros per year. So something started to change again in the early 80s with globalization, and the French economy fell off. I would also argue that there is another trend rate here that was growing, not quite as nearly as strong as this trend, but much more than the current trend. However, that broke again, much like the U.S. That broke in 2008. You can kind of see that trend here from the early 80s through 2008. You can see that kind of second growth rate. Well, that broke down and has been flatlining. So there's seriously missed potential in terms of real inflation adjusted growth. Well, something had to fill the place. Government spending has gone from about 40% to 57% just in the past 30 or 40 years. Now, here is GDP per capita, and it's even worse. So the break of that trend from the early 1960s through to the 1980s, the break of that trend, if you were to have kept that trend rate of growth on a per capita basis, you're talking about an extra $120,000 per year. Again, keeping the kind of 1980 to 2008 growth rate, you're talking about a missed GDP per capita of 21,000 US dollars per person per year. So there was a significant trend change, again, also for the US. Here is the growth rate, the annual growth rate of GDP per capita. Again, we can see that that has been declining going back to the 1960s, now running at a very anemic 0.8%. So again, CAC, the French stock index, there have been developments. I am not a French politics expert, so I will link an article that goes through some of the kind of finer intricacies of the French government. But it sounds like what is happening is there's an impasse, and the political solution to the rising bond yields, to the fiscal deficit, it seems like it is becoming untenable, and the government will end up dissolving. I will link that article down in the description so you can read from an actual expert. It was written, I think, by an investment firm in a letter to their customers, talking about the side of this situation that refers to the government. Sometimes the government can get together and go, okay, we got to raise taxes and we got to cut spending, and here's how we're going to do it. But it does not sound like that is possible. And so you have the bond market revolt. So here we're looking at the yield curve. In white is the 1 month yield. These are the oat yields for the French government bond. And then in yellow is the 2 year, orange is the 5 year, so on and so forth, out the colors of the rainbow, getting further in duration. Now, France has 50-year bonds. So I included that as well in purple. And what you can see is an even more notable steepening of the curve, even than the US. Over here, I included the interest expense in euros, in billions of euros per year. And what we can see is that it is dramatically rising. If we go even back to 2023, it was 50 billion euros per year. Well, just 2 years later, it is up 50%. To now 75 billion euros per year. So we can see, again, what's called a steepening of the yield curve, or the gap between the long end rate and the short rate growing wider. That is what's referred to as a steepening in the yield curve. So that's what we're looking at in pink. And if we go back to the beginning of August to look at August kind of on a monthly basis, the spread went from 2.1% all the way up to 2.37%, over, about a 20 basis point steepening between the 30-year yield and the 2 year yield. Now, this happens for one of two reasons. Either the bond market is expecting interest rate cuts. Now, remember, France is part of the ECB, the European Central Bank determines their interest rates. Either you get a bull steepening where all rates are coming down, but short-term rates like the yellow and the white line would be coming down very sharply. That's called a bull steepening, because remember, the inverse of the yield is the bond value. Inverted the wrong one there. I will take off the spread and invert this so you can see, get an idea for the value of the bond. So what you get in a bear steepening, which is bearish for bonds, as we can see, the value of the bond is going down, therefore the yield is going up. This is especially pronounced at the long end of the yield curve. So we can see the blue and the purple, the 30-year and the 50-year, are declining sharply. They really are starting to curl over and really kind of implode over the past month or so. And we can see that from the yields rising quite sharply. So here's a way to measure relative risk. So here you're looking at the yield of one country relative to the yield of another country. And we can see, for example, France to Germany up here in red. And then we can see France to Italy and France to Greece. And what I want to point out is that the French year, the yield on the French 30 is the same right now, just about perfectly, as the 30-year yield on the Greek government bond. Now, if you look at France relative to Italy, who, by the way, had a full-blown debt crisis in 2011, 2012, if you look at that spread, it is the widest going all the way back to even before 2005. It appears to be, at least according to my data, the widest spread, or the narrowest spread, excuse me, the most positive spread on record. So what this means is that the risk that investors are demanding in the bond market to buy French government bonds is that much higher than the the compensation or the premium that investors are demanding for Italian bonds. And the same is true for the premium on the French 30-year versus the premium on the Greek 30-year. Now, remember, both Greece and Italy had full-blown debt crises in the 2011s, in the early 2010s, kind of through 2013, and we can see what happened to the spreads there. Investors started to demand an obscene amount of premium to buy the Italian government bonds or the Greek government bonds. Well, what we're seeing now is the opposite, which is investors are starting to demand a premium to buy French bonds. That is what that is showing. Now, if you look at German bonds, Germany's always been kind of much stronger in terms of European economies. If you look at that, that is not nearly as concerning. It is approaching an all-time high, but it was still about 50, 60 basis points away from the all-time high spread that we saw back here. So here is the money supply as a share of GDP, government debt as a share of GDP, and then I threw on foreign exchange reserves and gold. So money supply as a share of GDP, very similar to the US, about 100% of GDP. The other way of thinking about this is if the numerator is growing faster than the denominator, the white line will go up, or the red line as we're looking at there. The numerator, debt, or the money supply, is growing faster than the denominator, which is the economy, gross economic output. And just like the US, this is the same story for France, which is they have been trying to print their way to prosperity. This is the case for many Western developed economies, print their way to prosperity, and it is not working. They are getting ever less GDP, ever less actual economic output for ever more amounts of money via the broad money supply with the M2, or debt, government debt. As we see the red line, government debt to GDP has gone from about 43% to about 110%. Now, foreign exchange reserves, this is why the French debt crisis really matters. So foreign exchange reserves refer to the savings, kind of on a national basis, of a country's economy. So here in France, I have it highlighted. You can see that as of the last TIC report, TIC report, we can see that France holds $375 billion of US treasuries. So when the bond market is melting down, as we can see with long end rates really taking a leg higher, as you can see, especially with the 50-year, just on a monthly basis. If we just look on a monthly basis, the 50-year bond yield has gone from about 4% to 4.25%. So the 30-year yield has gone from about 4.1 to 4.4. So the 30-year bond yield is up 30 basis points in a single month. I think it is pretty hard to say that we are not approaching, a full-blown crisis when your long end rates are rising 30 basis points with growth. Again, growth doing what we were looking at here, nominal growth only at 1.8%. When you have long-term rates rising because growth is rising, well, that's a different story. And that's kind of what we're seeing in Japan. That is not the story with France. Their growth is anemic. So they have poor growth, but they have skyrocketing bond yields. That is all the hallmark signs of a debt crisis, of a fiscal crisis. We can see that reflected especially in the long end of the yield curve. The blue is the 30-year yield, and the purple is the 50-year yield. So why it matters, again, France holds $375 billion of U.S. treasuries in those foreign exchange reserves, which is the purple line here. When a country is pushed to the brink, and they need to sell what they have, what they can, not what they want to. As Luke Groman always says, you sell what you can, not what you want to. Well, they have $375 billion of U.S. treasuries that they can sell. Again, remember, they are running a slight current account deficit, looking at the more recent data, and they are running the 7% fiscal deficit with interest expense that is up 50% over the past 2 years alone. And a look at bond yields, and you go, if interest expense is up 50%, because the interest rate on the debt is doing what it's doing, well, the past couple months is going to raise that interest expense even faster. Investors are demanding a higher and higher compensation or premium to buy the French government debt. And so what this means is this pushes the interest expense higher for France. Well, we established they run basically a twin deficit, slight twin deficit with the current account. So what that means is they're not generating enough revenue from trade to pay that interest. So what that means, they have to run a larger deficit. Well, larger deficit means more debt needs to be issued. That's how deficits are financed, is by issuing debt. Well, you increase the bond supply. If demand is not increasing, bond yields must go up or the value of the bond must go down. Well, that pushes your interest expense even higher. And now you have to run an even larger deficit, requiring even more debt to be issued, and so on and so forth. This is the debt doom loop, as people talk about. So, again, France holds $375 billion of US Treasury debt that they can sell. This is why rising rates in Japan or in France or in the UK, this is why it matters. So, just to recap, I'm going to try to give a summary for this particular video. I know people have been requesting that. France has gotten into this situation over many decades. Their public spending, their government expenditure as a share of GDP at 57% is just insane. I mean, this is kind of beyond the pale, even for a generous, country in Europe where government spending is obviously slightly higher than the US. 57% is you basically have no real economy at that point when over half of your economic output is just coming from bureaucracy and government spending. They have run ever larger fiscal deficits, as we could see in this slide here, going back again to the 1960s. The debt to GDP has been rising. We looked at that relative to the nominal growth rate, the interest rate relative to the nominal growth rate. We can see their debt to GDP, much like the U.S., has risen dramatically over the past couple decades. Of course, there's political instability, and again, European politics is much different from American politics. But from what I gathered, it appears there is no hope for political solution with this particular fiscal crisis for France, and that the government will end up dissolving. So it is not going to be solved by politics, it appears. And then finally, you have kind of very, very anemic growth. And again, this is the case for the US as well. We have done an entire kind of series on the silent depression framework for the US, but it is much worse in France. If we think it's bad here in the US, it is even worse in France, where their nominal growth rate has been below 2%, 1% inflation rate, and below 1% real growth rate. Again, this has been declining. We looked at on a per capita basis as well. It has been declining. So yeah, it would be one thing if they could stimulate growth. The problem to stimulating growth is this: their government spending is such a large share of their GDP that they can't really get very good growth, and their debt to GDP is so high, which kind of by definition means that the debt is unproductive, and the marginal return on each new dollar of debt is going down. As they issue more and more debt, the GDP that they get for each new dollar of debt is going down. So they are getting less and less and less return on their money supply and on their debt. Put another way, they must issue more and more debt to get the same $1 of economic output in GDP. So this is, shaping up to be basically a repeat of the pigs crisis of 2011, 2012. And we did a video on Italy in particular for, during the period of time of the pigs, Portugal, Italy, Ireland, Greece, and Spain. So I will link that here at the end. But anyways, it is not looking good. Again, remember, it's a little different with France. They are part of the ECB. Now, the ECB is not allowed to directly monetize the debt. They do have kind of a QE program where they can come in and buy maybe the long end, but it's only on the secondary market. They are not allowed to directly monetize the debt. And arguably, that might even be seen as a sign of even greater weakness, which could cause the bond market to revolt even more and push yields even higher because, oh no, it's gotten so bad the ECB has to come in and buy the debt. That's not a good sign. So, anyways, hopefully that was helpful. Got to watch the price of oil too, by the way. Hopefully that point, as well as the strength of the euro. Those are two critical issues for these kind of European debt issues: the price of oil and the exchange rate, the dollar euro exchange rate. Because again, no one else in the world wants a strong currency. The U.S. is the only one dumb enough to actually want that. And we can see that in the case of France and the ECB. They have said 120, anything above that, and it starts to hurt us so much that we don't want that currency strength. We want the currency to be weaker, and they will probably do something to get a weaker currency, whether that's interventions or the like. So, anyways, hopefully that was helpful. And I'll do a video on the UK as well. They are in very bad shape as well. I'll do that within the next couple weeks. So, anyways, hopefully that was helpful, and I will catch you in the next one.